Hey, all right. Good morning, everybody. So it's the day we've been waiting for. We have FOMC today. We had this 40-year KGB auction last night. We'll see if we can spot when that happened in the charts. There was some tweets that just came through. It seems like we might see some action over in Iran. These these tweets just came through and really kind of shook the market up. We have some of the Mag 7 reporting earnings today as well. So there's just a lot going on. You really want to be mindful of what you own, understand your risks. The NASDAQ is up close to 1%, and the S&P is up 0.25%. Typically, these two run a lot closer together. So you want to keep an eye on the two of these and see if the NASDAQ is going to catch down to levels closer to the S&P, or if the S&P is going to catch up to levels closer to the NASDAQ. But they should normalize, right? They should not stay this far apart. So that's one of the things that we want to be looking for through the morning, right? We've got monetary policy from Canada. We got the ECB chipping teeth this morning. Now this speech is at some ladies conference. It's not to say that it doesn't have any impact probability. It's just that it's a very low impact. I know it shows like a medium, but you got to take into account where the forum is, whether it's live or not, because sometimes these will be pre-recorded. Whether or not there's going to be any Q&A afterwards. So when you see any Fed speaker, whether it's US or some other nation, try to dig a little deeper and find out whether or not it's live, if there will be Q&A, if there's going to be policy talk, because if they're meeting at the Girl Scout Luncheon of America or something like that, and it's some pre-recorded message with no press or Q&A, it's a low impact situation, right? It's very likely that not not worth paying attention to. So don't take it on face value when you see that there's a speech by some Fed member somewhere in the world that there's possibility of shenanigans. We can see the impact of the Trump tweet. Feel that. I was looking through the rate probabilities. Um, it looks like they were unwinding a little bit of June and July, backing off a cut that was in there, not by much. Like really, for the week, things haven't shifted very much at all. Any cuts that are projected for 2026 are really still in the later part, September, October, December, and they're not in the front at all. And it seems that that is slowly solidifying a little bit more every day. It just tightens up that they're um, very casually unwinding any probability of a cut in the first part of the year. Now, of course, that can change rapidly, but at the moment, that is the steady decline. of probability. Yeah, yeah. Good morning to you too. I don't blame you. It's common for people to just take the whole week off, but I appreciate you being here. Looks like another big snowstorm is projected to hit the East Coast. This one coming from the ocean side. So while, like half the United States got hit on that last one, this next one looks to really just be hitting the eastern seaboard. Sucks to be you. So we had some moves in defense yesterday. It's possible we're going to continue to see that today, especially with this flotilla and those tweets that we saw out of the president. So XAR is the aerospace and defense ETF, or you could look at, Raytheon and Grumman. Typically, there would be something here on the president's schedule. Not seeing anything in there at the moment. That we might circle back to that towards the end of the stream and see if that gets updated. Let's just check this real quick. I know I updated it on the other account, but yeah, it says the 28th. Uh-huh. That's what I thought. All right. Hold on. With the spot gamma levels, sometimes I grab them a little early and then they're not updated. Yeah. I just grabbed it again to check, and there's two possibilities. One is they didn't update it yet, and by this time it should be updated. And or two, the levels didn't change enough for them to warrant a write on the new levels, and so they're just using yesterday's levels. It's absolutely possible. So I'll check back with that also later. We'll see. They line up with the levels in the picture. 7029 should be the call wall. Yep, it is 7030, same thing. 69. Yeah, it's right. They just didn't use a new document. They just kept the same one from yesterday. So we are negotiating with that call wall this morning. It's been a slow grind all week as we moved closer and closer to the edge of that weekly expected move. And I gotta say, I'm quite proud of that call out this week. When it comes to earnings weeks and in the Mag 7 and FOMC weeks, the base case arguments for that hurry up and wait, go sideways theme is generally just like a default thing, right? There's not much of an argument to it. But a lot of work has gone into this over the years, studying and reviewing previous FOMC weeks. And so on Monday, when we were still below the Friday close, we were down here somewhere. I mentioned the possibility of going to the edge of the weekly expected move even during an FOMC week if we could get a breakout of Friday's level and or Thursday's level. That's all we needed, right, for that confirmation. Now, I got to say, I was really expecting that to get all the way up there by the end of Monday, maybe Tuesday at the latest, right? Because that's typically how it goes. But still getting up there, all we had to do is break out of last week's range or Thursday or Friday's range, and we did get up there. So, they say you can't anticipate these Fed weeks, but I'm going to continue to argue against that. We've got enough data and enough evidence that we can anticipate the kind of week that we're dealing with. And this is the first of many to come, right? Because if we can demonstrate it once, we can do it again and again and again. Overnight volume was really strong. We had that auction last night as well in Japan with the KGB. That would have come in really right through that zone here. It's likely it was right during that bump, right? That breakout there. Not as impactful as I would have anticipated it, but the participation in the overnight was solid. 90,000, that's really good for an FOMC day. They're certainly not sitting out. And it's been that kind of week all week, right? Like it wasn't even an FOMC week at all. That's the kind of behavior that we've been seeing. So, when we've got a high confidence in what the Fed is going to present, then there's less uncertainty. The market is comfortable with the idea that um, we're going to just stay where we're at. We're not going to get a cut. We're not going to get a raise. We're just going to sit tight. And looking at the projections for the next few meetings, the market seems relatively certain that we're not going to get any cuts anytime soon. So it's pretty much business as usual. The FOMC meeting doesn't have much to offer at this point. I don't see the market in doubt or confusion, and I don't see that it's looking for any guidance. It seems pretty confident with the Fed's position. We talked about getting back up to this level earlier in the week. And the main issue that we were hung up on was Monday when we were down here, and whether or not this was going to end up being a lower high. Well, by the end of Monday, we had already rallied back up through those levels, and that took that lower high off the table. And now we managed to get higher than this high. So no matter what happens next, we did set that higher high. And it matters, right? Like in the big scheme of things, it does matter. Now it's still a complex topping pattern because of this situation here. But on the top side, we are continuing to climb. And depending on the analyst, this pullback might not have been enough of a pullback to warrant a measurement at that level, right? One trick that you can do when you're trying to see these more clearly is turn them into a line chart. Doesn't always help, but of course you want to take your moving averages off as well so the line stands out better. But that can clean things up quite a bit. Now that we zoom out, we have a bigger picture. Higher lows, higher highs. It might be a bit ugly, but it is climbing. So now we want to focus on this level back here from October. We don't know how much is out there at this level and whether we're going to be able to make it through there or if we're going to stall out again. It's today, right? This day is above that level, but this day isn't done yet, so we can't count that. If we get this candle close above that level, then we're good. But the last time we got up here, we got that candle close here. The next one tried to continue through that zone, and it wasn't able to do it. We tried again to get through that zone, and we wasn't able to do it. We got up in there yesterday, and we closed there. So today matters in more than one spot, right? It matters. So that's what we want to continue to focus on, big pictures, where this is going, right? We reached the edge of the average daily range, the ADR here. And the phrase goes, if we reach one side early enough in the day, we can reach the other side by the end of the day. This is not a bullish or bearish statement, right? Because we could have reached the lower edge and then we would be talking about the upper edge. But that's not a statement on bias or direction. It's just a statement on the way price moves, right? These waves, it's what it does. So we have reached one side early enough, and even though the day is half done, there's still enough time to reach the other side by the end of the day. Now I know, I get it if you're new and you haven't heard that phrase before. The market is half done today, right? We opened last night at 6. It is past 6 a.m. now, so the trading day is already half done. You slept through it. So we want to focus on the levels like we always do. We're negotiating with the mid right now. Break the mid to test the Globex low. Break the Globex low to check yesterday's RTH low. Get below that and you've got the ADR down here, which is really close to the full low of yesterday. It's not the full low, but it's really close to it. And we can just go ahead and move on down there. Another pivot that's in all of this mess would be the RTH open of yesterday. It's not a perfect level since it's so close to the RTH low, but wouldn't hurt putting it on there. I don't want too many levels, right? So for me, probably just keep it a little cleaner. There we go. So there's our Globex low. Now we can focus on the mid of yesterday. That would be another solid level. There's the real mid, which is what I just marked out. And then there's the RTH mid. Both of those are valid levels. So as you can see, now that we've got those in place, we've got a lot of levels to the downside, and we would just use that as destination trading and target each level one at a time. Get to one, get through it, aim for the next, get through it, aim for the next. Not only does it provide you an opportunity to take another bite of the apple so that you can get in and out, if you're trading something else like options in the SPX or SPY, you just get in and stay in, right? Run it till it breaks. It's a great approach to trading because you can adapt it for whatever you want. Destination trading. To the upside, it's really, really simple. Get back through the half, get up to the ADR mid or the ADR low, and aim for the high. Ta-da, done. That's easy. I need that button from Kohl's, right? That was easy. We'll put it right next to my magic 8-ball. All right, looking back at yesterday's floor pivot, we have a MDP. That's a missed daily pivot. It counts now because the day is done and we went through the entire day without hitting that floor pivot. It is worth evaluating the S&R levels of yesterday, especially since we are going to need to negotiate with them again today. We didn't hit the R1, but we are already through the R1 this morning. We missed R2. Now we're negotiating with it again after having come back down and we've been interacting with it. There's an old market concept that says R1, S2. That'd be 69.50 down here. And again, that's not bullish or bearish, right? That's just market logics. So we went to one side. Now we're looking at going to the other side. If you've done any research on these, though, the R1 S2 or the S1 R2 generally fits in a logic that focuses on how price moves. So, for an example, if you've had price moving to the downside, say over a period of 2 or 3 days, and then you get a bump to the upside, that would be your R1, before continuing to the downside into something like your S2. That's where that R1 S2 comes from. So that logic really doesn't fit when it's a sideways market and we're just chopping about, right? And we reach an R1. That would mean that we're looking for a breakdown out of the range to get to the S2. So it's a completely different model set. Still, we did make R1 and some, but we failed to get into that R2. So if we do get back above R1, then negotiate the mid of this, get back to the high, get through that Globex. We'll focus on R2, and then we've got R3 up here. There's no reason to anticipate we're going to get an R2 or an R3 today with everything else that's pointing to the downside. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. And so far today, we haven't hit it. It won't count as a missed daily pivot until the end of the day when we look back and say, oh, wow, look, we didn't hit that pivot today. So until then, till we get to the end of the day, this is just a potential missed daily pivot. Generally, we get these missed pivots as a part of a turn when we start working our way back up through these levels, right? There's a missed pivot. There's a missed pivot. But we had 2 days where we didn't miss the pivots and we stalled out, kind of went sideways. So this would have been a symbol of a stronger rally if we had gone every one of these days higher without hitting the pivot. But those 2 days between Friday and Monday, where we kind of stalled out and got tangled, took that consecutive missed daily pivot off the table. At the moment, one of the concerns that I have is how far away we are from that weekly pivot. I have tried so many different ways to calculate an evaluation of distance in a consecutive format. How far away can we get from the weekly pivot before it's too far? I don't have a good answer. From all my work that I've done, I know that we can get farther away to the downside than we can from the upside. So if we overshoot it to the upside, we are more likely to mean revert back down. But by how much? And I just really have not found good answers to that question yet. It does depend on how often we are expanding above that weekly pivot. So if we, got 2% above it last week and 2% above it the week before, then it's more likely that we can get 2.5 or 3% above it this week without that being too much. But if we haven't been testing those boundaries and we try to make a 3% move, we're likely to just take a rejection. Right now, we are not very far away, all things considered. I thought it was farther than that. It's not even 2%. But 2% is what we have to work with. So if we break our own Globex high and we make a run to the upside, that might get us into R2. Right? Maybe. That does. It gets us right to the R2. But that's about as far as I would expect today. And on the week, I don't think we can get more than 2.5, possibly 3% away from this floor pivot down here before it becomes too much and we get some sort of mean reversion. And that's likely to be some spike on news, right? Whether the Mag 7 earnings or something that Powell says today, that we get a good shot to the upside and then swiftly come back in again. Because we just can't get too far away from that. If we do start making moves to the downside, the floor pivot is the target. So our own Globex low, and then beyond that, we got the floor pivot. If we get underneath the floor pivot or outside of that channel, then S1 is the target. Of course, you got the cog line down there, 69.92 cog line. But again, it's just destination trading, right? So another reason to focus on the downside, level by level by level. We got plenty of targets down there. Nope, they're not hedging this morning. It was it's a little odd, I guess. All that volume that we saw kind of told me we likely weren't going to see hedging either. So it's not too surprising. No, it's a good question. All right, so I pointed out this point of control from 2 weeks ago. If we make moves to the downside, we got that 7,000 big round number, and then 92 cog, and below that, we've got this point of control, which happens to still be our current week's point of control. Now, what's more likely is that we fade down into this volume shelf here, and we end up bringing our point of control up into that 7011 cog line area. If we just drop down through it like a stone, this shallow area likely doesn't provide much of a support, and we just fall right through that and come right back into this lower level in that point of control. If we cut through that point of control, 69.50 is on the table. Remember, we're running 50s. 10-day, 30-minute volume profile in TPO. It's a really ugly chart. There's nothing really awesome about this right now. Certainly no textbook patterns. We got a wide value area with 2 distributions. Looks like we're trying to build out a third. We got a disagreement with the TPO and the volume profiles point of control. It's likely that the TPO is lagging behind and we're going to see it come down later. 6942 is an old school cog line. We don't use that one anymore, but we used to, and it's one that sticks to the memory. Wouldn't be a surprise to see that point of control come down into this level. We are going to start hitting the candles that made that level in the later part of today, overnight into tomorrow. So if we don't revisit that zone today, it's possible that by tomorrow we'll see this volume profiles point of control move up here to the TPO's point of control. Of course, we're going to be wiping those candles out the next day, and the clock is ticking before we see this get a significant change. All these lower candles down here, they're a long ways away, right? We're talking about a week at least before we start to narrow this profile. And by then, depending on how things go this week, we might be back in that zone already, 68.50 area. I have no reason to think we're going down like that, right? That it's not my base case argument to be that negative. So if we don't go down there, we'll have a much narrower profile, or we will have expanded this profile to the upside and we'll be a lot closer to that 7100 area. All right, we finally took out that January 15th VPOC level. We're done with it now. It was there for quite a while, and you can see how we negotiated with that level yesterday before we finally was able to get through it. And even after we did get through it, we checked that sucker from the other side, right? So it continued to hold value through the entire day. We are done with it now, though, so we don't need it anymore. We're going to just take that line and bring it up and use it for today. Let's get it moved over into this zone first, then we'll bring it up. All right, because you can see how yesterday's point of control, it's not a VPOC, it's just a POC. So we want to change it just enough so we know that it's not a VPOC. It's just a regular POC. But I would keep track of that level today, right? If we do make a move to the downside, I normally don't, but the textbooks will tell you to carry the value area high and the value area low and the point of control forward every day. That's what the books say. I don't need it every day. I've got my own pivots, but for today, it might provide some insight if we break down. The reason it's not a VPOC is we already passed through that level with these candles last night, right? So we don't need it at this point. But from a VPOC's perspective, we're done with it. From just a point of control perspective, I think it might be valuable for today, right? To just keep that on there in case we break down, get into that 7011 cog line. You might want to know that it's there, right? Otherwise, the VPOC and the volume profile, they're lined up really well. We can see that buyers got exhausted last night. We didn't go down because sellers attacked. We went down because buyers got exhausted. See if that matches later in the morning if we happen to take another run at that high. All right, now as I mentioned at the start of all of this, the target was the edge of the weekly expected move. Ta-da, we're there. Now we got FOMC, we got to deal with the Mag 7 today and tomorrow that we have to deal with. So we'll see what comes after it. We have a 70% chance of closing inside this boundary by the end of the week, right? We're talking about Friday expiration. 70% chance that we close inside that box because it's a 1 standard deviation projection. We are more than 0.5% above the 10-day. It's a healthy place to be. And when we look back, I just put my mouse there and we look left, you can see that oftentimes this is about as much as we get. There's plenty of examples of us stalling out right here at less than 1% or around 1%, right? Because if I just move this up a little to 1%, you can again just look left and see how many times that was the end of the move and we turned around and went back the other direction. So that's one of the reasons that I'm not looking too far to the upside. Now, on the other hand, we do have examples where we crossed that level and we continued to go higher, right? We got some examples here and here, but it didn't last long, right? 2 days, 3 days, and then we were right back underneath that level again. So even if we do continue this drive to the upside and we get further than 1% away from that 10-day, we're not expecting to keep it. That does not mean we fall. Remember, all we have to do is sit tight and the 10 will come to us. Just the way it works, right? It's like a lost puppy just following us around. So the fact that it shows us coming back to the 10 is misleading because we can just sit in one spot and the 10 will come up to us. But it does show that we would not continue to advance farther than the 10 is moving and that we would start to close that gap again. So just keep your eye on the distance with 10, how far we get away from it. If we do get some upside moves today, with Powell talking and the volatility that we can get during FOMC, keep track of how far we get from that weekly pivot. If we get 2.5% today, maybe 3% away today, that'd be a nice reversion on the day, right? To get some whiplash play short across the afternoon. Maybe on one of his comments that spikes us up, we just short that sucker back the other direction. Intraday plays, right? Looking at our distance from the 10-week, we're at 1.5. That's not bad at all. Anything above 1% is good. As far as I'm concerned, we get below that 1%, we're more likely to come back and make contact with the 10-week. But we're above 1%, we're closer to 1.5. And that means we can keep it and we can continue the move to the upside. My concern here, if I just zoom out more so we can see it better, is this decline. Now that I've zoomed out this far, you can really see that decline better. It's been this continuing narrative. I'm still looking for that to break, right? I want something up here. And we haven't got it yet. Now, there's still some tail left in here, right? There's still a little bit of room. But if you guys have heard me talk about wedges before, you never want to get into that last 20%, right? And it doesn't really matter what kind of wedge it is that you're talking about. Flat top rising wedge, flat top falling wedge, rising wedges, falling wedges. I don't, asymmetric wedges, I don't care. You don't want to get into that last 20%. And I don't think this is any different. So we're kind of getting to the point where something's got to break. And in this scenario, there is only one way to break it. Because if we go underneath it, it still doesn't break it, right? Just kind of put that back for a moment. Getting underneath down here would not solve this problem. It would be the next time we come up. And at some point, we will come through that level. 2.5, 3, 3.5, something. But will it be in this quarter, or is it going to end up being in the next quarter? Either way, the clock is ticking. We're running out of time on it. It's going to happen. On FOMC morning, it doesn't do us any justice to come in and see the things that are up or the things that are down, but we'll do it anyways. Looking at what's down this morning, the benchmark I use is 0.5%. The Mag 7 down volume is down 0.75%, and yep, that's a double negative. And nat gas is down, and really that's about it. You flip that over and look at what's up this morning. What's up? Chips, uranium, UFO, China again, quantum, Mag 7 up volume, gold miners, tech, generic tech, expanded tech, IBIT, so Bitcoin, solar. My goodness, nearly every single sector and industry that we keep track of is up this morning. The ones that we would look for or look at for an upside rally, right? We would look at chips and telecommunications and the Mag 7 constituents, and we would look at Bitcoin as a risk asset. All of those are up, every single one of them. When I see that and we have that much, I circle back and look at why are we down? Why are we down off of this Globex high? Sure, we're still up this morning, you know, 0.25%, but we're down off of that high. Why? That goes back to the argument, don't expect us to continue to outpace that weekly expected move. We've hit it now. That was the target. We're looking for FOMC, so it's very likely that we just sit tight now, go sideways into FOMC. It doesn't owe us any more of a move to the upside, and there's no reason to think we're going to go to the downside with that much structure and those sectors all up this morning. There have been days in the past where we had this much bullish bias and we still went down at the open. The orange line that you see here is yesterday's high. It is simple enough, level by level by level, just like we talked about at the open. So we'll finish with the same summary, GTFO. It's always GTFO. You got to get out of the box, right? Get out of this box to do anything else. That is our range that we have to deal with. If we get out of that range to the downside, then we have yesterday's range to deal with, both from the RTH perspective and then all of yesterday's perspective. They're two different zones, right? So GTFO, if we get out of this box to the upside, we got 70.50 and then 7100. To the downside, we have yesterday's RTH mid and then yesterday's full mid. I don't care how many sectors we have or how many industries we have or what names are up this morning. I'm telling you, I've seen it before. We will see it again. You can have everything bullish, and still go down at the open. Just the way it is, right? So don't let the bias confuse you. We are getting a breakdown right now. We're sitting here watching it. Even with all of those things bullish this morning, it's still breaking down. So don't fight it. Get through the mid, target the levels that we've been talking about. I gave them earlier. And just run it on down until we stop making new levels to the downside, right? Keep your eye on the clock. Opportunities will come all day today. And I'll see y'all tomorrow. Be careful, be safe, have a good day.